Welcome to the deep dive. Today we are cracking open a company that, it's been kind of the silent backbone of the global repair industry for, gosh, over a century now. Snap-on Incorporated, trading under the ticker SNA.
Yeah, Snap-on, it's definitely more than just, an industrial manufacturer. It's really a global institution, a premium brand that pretty much defines the tools professional technicians use everywhere. Leading supplier of tools, equipment, diagnostics, the whole package.
But what really makes it stand out and why we're doing this deep dive is its competitive moat. It's built around something really unusual.
Exactly. It's this incredibly durable business model, this direct technician franchise network. That's the core.
Right. It's not your standard distribution system at all. It feels like a fundamental structural barrier, that direct franchise approach. It's just incredibly sticky. And, that's why Snap-on has stayed so profitable and resilient for so long.
Precisely. SNA is a cash-generating machine, incredibly disciplined operationally. But, and this is the big but, that historical strength is now facing maybe the single biggest technological challenge in the auto world today. The shift from internal combustion engines, ICE vehicles, to electric vehicles, EVs.
That's the real tension here, isn't it? You've got this proven historical strength, this mechanical expertise bumping up against this massive technological disruption from electrification. It's a classic value investor's puzzle.
It absolutely is. So our mission for you, the listener, is really twofold. First, we need to properly unpack the mechanics behind Snap-on's, frankly, industry-leading profitability. We need to really get under the hood of that famous moat.
Understand all the layers.
Yeah, and second, we have to critically look at the odds of the company pulling off this huge strategic pivot. Can they really capitalize on the EV service market?
Yeah.
Because honestly, that pivot, well, that's what's going to determine its long-term value creation.
Okay, let's get into it. Starting with the heart of that competitive advantage, the moat itself.
Right. So to really get Snap-on, you have to understand the power of this franchise network. It's not just how they sell stuff. It's about owning that customer relationship right there at the point of work.
Yeah.
Creates this barrier that's just incredibly tough for competitors to even think about replicating.
It really is unique. This whole thing is the foundation for their tools group, their biggest segment. They manage this global network. What is it? Around 4,800 franchise-run mobile vans.
Roughly, yeah. Those iconic red and black trucks you see pulling up to auto shops, dealerships, even aviation hangars. And about 3,450 of those routes are just in the U.S.
And the key thing, you mentioned this, these franchisees are independent business owners. They're not employees.
Exactly. Crucial distinction. They buy the tools from Snap-on wholesale, then sell them directly, face-to-face to the pros. They're basically running their own mobile tool stores on wheels.
The genius here, I think, is that customer connection. I mean, the technician doesn't have to waste time going to a store or waiting for an online package. The store literally drives up to their bay door every week.
Right. That regular weekly visit from a familiar face. It's just deeply embedded in how the repair industry works. It creates these huge switching costs. It's not just buying something, it's kind of a relationship.
And it's more than just loyalty, isn't it? You mentioned this feedback loop.
Absolutely. That face-to-face time is what Snap-on calls customer connection. It's invaluable. The franchisee is like a real-time market researcher on the ground. They see a tech struggling with a new part, they spot a gap in the tool lineup, and boom, that info goes right back to HQ.
So product development isn't happening in some isolated lab. It's directly fueled by what's actually happening in the repair bays.
Exactly. It drastically cuts the risk of launching some new tool that nobody actually needs or wants. The R&D starts with a real, documented need from the person doing the job.
And that connection, that feedback, it shows up in the loyalty numbers.
Oh, yeah. Customer surveys back it up. Snap-on's loyalty score is what, 84%? Which is remarkable.
That's higher than Stanley Black & Decker, which is impressive in itself at 81%.
It is. It shows that lock-in is real.
Okay, but let me push back on that 84% a little. Is it purely emotional connection and quality driving that? Or is it just, the hassle and cost of switching once you're up in their ecosystem? If you've dropped thousands, maybe tens of thousands, on Snap-on tools over years.
That's a totally fair point. And the answer is, it's probably both. The foundation is definitely the brand equity. The Snap-on name is seen as the gold standard.
The Rolex or Rolls-Royce comparison you hear sometimes.
Right. It's aspirational. For a serious tech, having that Snap-on tool chest, It's a statement. It says you're serious about your career.
And that perception of quality, which surveys back up, they're always ranked #1 in product quality score that justifies the premium price.
Absolutely. And they guard that premium pricing fiercely. Management deliberately keeps Snap-on tools out of those price-sensitive channels, like DIY retail stores. You just won't find them there. They protect that positioning, those margins, almost religiously.
But because they're premium, they're expensive, often way more than competitors. And that's where the next piece of the moat clicks in, right? The financing.
Exactly. The price makes financing almost necessary, especially for younger techs just starting out. Building that initial massive tool collection, we're talking a huge capital outlay just to do their job.
So the financial services segment basically exists to solve the problem created by the Tools Group's premium pricing. It's this neat, closed-loop system.
Perfectly put. This segment provides financing credit lines for the franchisees to stock their vans, and then loans directly to the technicians for the big-ticket stuff.
So the franchisee isn't just a salesperson, they're also kind of a mobile credit provider.
In effect, yes. They let the tech buy that expensive diagnostic scanner or toolbox with manageable weekly payments, sometimes even interest-free on smaller things. Think about the convenience the tech makes their payment right there at the van. No trip to the bank needed.
And that integrated financing creates this incredible stickiness. It makes it really, really hard to just walk away from the whole ecosystem when you've got this ongoing payment plan with a person you know and trust who shows up at your workplace every single week.
It's a system where every part reinforces the others. The brand justifies the price. The price needs the financing. The franchisee delivers the product and the financing. And that interaction fuels the innovation. It's just this self-feeding, high-margin machine. #hack operational segments and current headwinds.
Okay, so we get the core moat now. But Snap-on isn't just one thing, right? It's actually 4 different businesses operating under one umbrella.
That's right. And their performance right now varies quite a bit across those 4 segments.
Let's start with the biggest, the core, the Snap-on Tools Group, the van network. That pulled in nearly $2 billion in 2024.
Yeah, $1.99 billion, about 35% of total revenue. And it has really strong operating margins, around 22.5%.
And this segment shows that resilience we talked about, even with economic jitters, auto repair is pretty non-discretionary. Car breaks down, you got to fix it, right?
Exactly. Recession or not. And we saw that in Q2 2025 results a modest but steady 1.6% organic sales bump, mostly driven by the U.S. network.
Management seems aware of the uncertainty, though. They talked about a strategic pivot within the Tools Group.
Yeah, focusing on quick payback items. What that means is maybe less focus on pushing those huge, expensive tool storage units and more on smaller things, consumables, specialty tools needed for a specific job right now, things that give the tech an immediate ROI.
So like a specialized socket set or maybe a code reader that solves an immediate problem they can bill for.
Exactly. Rather than trying to sell a $15,000 tool chest upgrade, which, requires the technician to feel pretty confident about their future earnings, it's a smart defensive play to keep volume moving.
Okay. Moving on from the core, we hit the more cyclical part, the commercial and industrial group, SNA.
Right. This serves industries outside typical auto repair. Think aerospace, defense, military natural resources, power generation. It's still a big piece of the pie, about $1.48 billion in sales, roughly 32% of total revenue.
But this is where you see the macroeconomy biting harder, right?
Yeah.
It's much more sensitive to things like corporate spending cycles.
Absolutely. Unlike the Tools Group, C&I feels the impact when big companies tighten their belts or delay major projects.
And Q2 2025 really showed that sensitivity. A pretty significant 7.6% organic sales decline, and margins took a hit too, down 320 basis points. That's a big drop.
It is, and management pointed directly to project delays and disruptions, especially overseas, Asia-Pacific and Europe, were mentioned specifically. So if you dig into that, it's not about individual techs buying less. It's about major high-dollar industrial projects getting put on hold.
Like big mining or power plant projects getting paused when global growth looks shaky.
Exactly. Those require huge outlays for industrial tools, and they're often the first things to get deferred. So, yeah, it flags that cyclical caution in big industry globally.
Makes sense. The stability in the Tools Group is kind of smoothing out the bumps from C&I. Now let's talk about what might be the most important segment for the future. Repair Systems and Information, or RS&I. This is the high-tech side.
This is strategically vital, yeah. It provides the diagnostic hardware, the software, the electronic parts catalogs, the repair info. Basically, everything modern shops and dealerships absolutely need to function. Generated $1.8 billion in sales in 2024.
And the financials look really good here. best-in-class margins.
Absolutely. Superior operating margin 25.3% in 2024, and it actually ticked up to 25.6% in Q2 2025. That kind of expansion tells you the economics are really favorable.
It smells like software margins.
Pretty much. Once you've built that diagnostic platform, the cost of adding coverage for, say, a new EV model via a software update is almost zero, but the value to the shop, immense. That's why it's seen as the future growth engine. It had strong organic growth too, 2.3% in Q2, especially driven by OEM dealership business and those complex diagnostic tools.
So the value prop is shifting, less about the physical wrench, more about the software telling you which wrench, or if you even need one.
Precisely. And that brings us to the last piece, financial services. We know it's a crucial role in enabling sales, but it's also like a canary in the coal mine, right? A real-time indicator of technician confidence.
And that canary was looking a bit cautious in Q2 2025. Loan originations were down almost 5%.
Yeah, down 4.9% to $293 million. Now, that's manageable, but it directly reflects less demand for those big-ticket discretionary items we talked about, those fancy tool storage units especially.
So techs are still buying the necessary tools for the job at hand, but maybe holding off on that big upgrade until the economic picture looks a bit clearer.
That's exactly the read. The health of this financing arm gives you a direct pulse on the psychology of their core customer.
Okay, now for the main event, really. The central challenge facing Snap-on, the EV transition. This is the ultimate test, and we need to understand the threat before we look at how they might pivot.
Let's call it the iceberg, the structural threat, because the mechanical simplicity of EVs is a direct hit on the traditional tool business.
And the numbers are just stark. An EV powertrain has, what, around 200 parts?
Compared to maybe 1,400 in a typical ICE car,
Yeah.
we're talking an 86% reduction in mechanical components, which means an 86% reduction in the need for specialized tools to fix those specific parts.
That just eliminates entire categories of tools that were, profitable staples for decades.
Totally. Think about complex exhaust systems, fuel injectors, engine blocks, cylinder heads, turbos, all that specialized stuff. Gone. Even routine things like oil changes, spark plugs, poof, vanished.
And the long-term hit to the aftermarket. EVs are expected to generate maybe 40% less service and parts revenue over their lives.
That's the estimate floating around.
Yeah.
Up to 40% less. Snap-on simply cannot afford to just sit there and watch potentially 40% of its future market shrink away.
So that forces the strategic opportunity, the pivot to tech. Because while EVs are simpler mechanically, they are way, way more complex electronically.
And that plays right into the strengths of that high-margin RS&I segment we just talked about.
So diagnosis becomes the new wrenching, essentially. Less listening to the engine, more plugging in and running software.
Precisely. The skill shifts from mechanical field to software interrogation. And RS&I is critical because they have to constantly update their diagnostic software.
Yeah.
Covering new models like the Ford Mustang Mach-E the second they appear in service bays is crucial. This just elevates the importance and the profitability of RS&I even more.
But it's not only software, right? The physical tools themselves have to change dramatically for EVs. High voltage systems mean completely new types of tools.
And importantly, high-margin tools.
Right.
Because these aren't optional upgrades. They're mandatory for safety. You absolutely cannot mess around with high-voltage batteries.
So we're talking about things like special insulated wrenches and sockets rated for 1,000 volts plus.
Exactly. Specialized multimeters, safety gear. Snap-on's already on this, offering things like a comprehensive electric vehicle general maintenance kit. These aren't just tools. They're basically personal protective equipment mandated by safety rules.
And you can't ignore the sheer weight. Those battery packs are massive. Shops need specialized lifts.
All right, managing a 1,000-pound battery pack needs heavy-duty gear. Snap-on selling things like a 1,200-kilogram capacity EV battery lift. Again, high cost, high margin, and essential for any shop serious about servicing EVs.
And maybe the biggest opportunity hidden in all this is the need for technician training.
Huge. Absolutely huge. Working on high-voltage systems is dangerous. Genuinely lethal if you make a mistake. That creates this massive, ongoing need for certification and training.
And Snap-on is positioning itself to be a key provider here, partnering with organizations like the IMI.
Yeah, the Institute of the Motor Industry. They're offering Level 3 EV repair qualifications. They want to be the go-to resource.
Okay, let's dig into that training angle. How big could that market be? And are other tool companies trying to compete on certification too? Because if this becomes mandatory for insurance or liability reasons?
Well, the market's potentially enormous because the skills gap is vast. Most existing techs have zero high-voltage training. Now, other companies offer training, sure, but Snap-on has that unique advantage, the franchise network.
The van that's already showing up every week.
Exactly. They can deliver the tools and the certification needed to use those tools safely right there at the shop. It's an integrated solution that's very hard for others to match. They can become the certified provider of the entire high-voltage service ecosystem for many shops.
So the bottom line on the EV transition is it's forcing a shift. Value is moving from the mechanical to the electronic, from the hand tool to the software and safety compliance. And this shift is basically accelerating Snap-on's move towards that higher growth, higher margin RS&I group.
Which, over time, should structurally lift the company's overall profitability and maybe even its valuation multiple. #tag financial strength and management discipline.
Okay, let's pivot to the financials, because the story here isn't really about explosive growth, is it? It's more about incredible efficiency and discipline over decades.
That's exactly right. Snap-on creates value through operational excellence, through continuous incremental improvements, not just chasing top-line growth.
And you see that in the gross margin, right? It's consistently strong, always around 51, 52%. But the real magic seems to be their operating efficiency, driven by that rapid continuous improvement program, RCI.
RCI is core to their philosophy. It's about constantly finding ways to cut waste, streamline processes everywhere from manufacturing to the back office. And the results, well, they speak for themselves. Since 2005, RCI has boosted operating margins by a total of 1,620 basis points.
Wait, say that again? 1,620 basis points.
1,620 basis points, reaching 22.7% operating margin in 2024.
That's staggering. Let's bring that down. That averages out to roughly 85 basis points of margin expansion every single year for nearly 2 decades. That's not just good management. That feels like it's baked into the company culture, almost automatic regardless of the economy. They just find ways to get leaner.
It's genuinely exceptional, especially in the industrial space. And that relentless focus on efficiency translates directly into fantastic returns on capital.
Right.
Return on equity, ROE, is strong at 18.0%. But return on invested capital, ROIC, the real asset test, is consistently around 20%.
And just for context for you listening, 20% ROIC. The average for the machinery industry is closer to 12%.
Right. Snap-on generates almost double the return on the capital it puts to work compared to its peers. That huge ROIC premium is probably the clearest financial proof that the moat we talked about is real and effective.
And this high-quality profit engine just pumps out cash. Predictable, reliable cash.
It's a cash machine. Generated nearly $1.14 billion in free cash flow, FCF, in fiscal 2024. And here's a key thing for you to notice. Their cash from operations, $1.22 billion, regularly runs higher than net income, which was $1.07 billion. That difference is often a great sign of high-quality earnings, less funny business with accounting.
And all that cash lands on a balance sheet that's basically a fortress. As of Q2 2025, they had more cash than debt.
Yep, $1.5 billion in cash and equivalents versus $1.2 billion in total debt. A net cash position. Plus, the business isn't super capital intensive. CapEx was only about 7% of cash from operations last year, so almost all the cash generated is truly free.
Free to go back to shareholders.
Exactly, which enables this really disciplined, shareholder-friendly capital allocation. I mean, the dividend record is incredible. Paid every year since 1939.
Wow, since 1939.
And they've increased it for 16 years straight. The 5-year dividend growth rate is a hefty 14.66% CAGR. That shows real long-term confidence from management.
And they buy back stock, too, actively. They just authorized another $500 million repurchase program in August 2024.
Right. You don't commit that kind of money to buybacks unless you're very confident about future cash flows and, frankly, probably think your stock is a decent value, even if it's trading a bit above historical norms.
And this confidence seems rooted in solid management. The CEO, Nicholas Pinchuk, has been there since 2007. He's really the architect of this modern strategy.
He is. He talks a lot about the dignity of work, which really resonates with their core customer, the professional technician. It aligns the company culture with the end user.
And management's incentives seem aligned too. Significant stock ownership requirements.
Very much so. The CEO owns, I think, over 815,000 shares. When the leadership has that much skin in the game, personally tied to the long-term success, well, it definitely bolsters confidence in the strategy and their ability to execute. #valuation context and future scenarios.
Okay, so we've got this picture. High quality, resilient, cash machine, great management. How's the market valuing all this quality? You mentioned it trades at a premium to its own history.
Yeah, the trailing PE ratio is around 17.8 times. That's definitely above its 5-year average of about 15.4 times. So the market clearly appreciates the stability and the quality of that franchise model.
But, and here's the flip side, when you compare it to other top-tier industrial companies, especially those maybe perceived as having higher growth, Snap-on looks cheaper.
That's the interesting part. On an EV to EBITDA basis, Snap-on is around 12.0 times. Compare that to giants like Illinois Toolworks, ITW, at maybe 18 or 19 times, or Parker Hannifin PH, which can be over 20 times.
So that discount suggests the market is pricing in, what? Slower growth?
The EV uncertainty, both, I think. Investors are basically saying, okay, we see the quality, it's undeniable, but we're not totally convinced about the future growth trajectory, especially with this massive EV shift happening. Yeah. The whole debate about unlocking more value really boils down to whether that pivot to EV service can actually reignite meaningful top-line growth.
And management knows this. They've laid out these strategic runways for growth to try and counter that narrative.
Yeah.
The first one is expanding sales to shop owners and managers.
Right. Moving beyond just selling to the individual tech. This is a direct play to boost the RS&I segment. Instead of just selling one tech, a diagnostic tool, you sell the shop owner a subscription to the whole platform or a complete shop equipment package. It's a higher value B2B sale, targeting the decision maker with the budget.
Increases the revenue per stop, basically.
Exactly. And the second big runway is pushing further into those jitters. Critical industries, aerospace, defense, mining, leveraging that brand reputation for durability to diversify revenue away from just automotive and stabilize the cyclical C&I segment.
And they've made some acquisitions to support that, right? Bolting on companies in specialized industrial areas.
Yeah, smaller targeted deals like mounts for precision torque tools and SAVTQ for specialized industrial tools. It's about strengthening C&I's offerings where high performance is non-negotiable.
Now, if you look at Snap-on through a sum-of-the-parts lens, the case for a potentially higher valuation gets more interesting.
It really does. Think about it. The RS&I segment is growing faster, it's heavy on software, and it has those superior margins, 25.6%, versus the tools group's 22.5%.
So theoretically, the market should give RS&I a higher multiple, more like a tech or software business.
Yeah, you could argue that, yeah. If RS&I deserves, say, a 20x PE multiple, while the more traditional tools group stays at its historical 15x, then as RS&I becomes a bigger slice of the overall profit pie, the company's total blended valuation should naturally drift upwards.
So the better RS&I does, the more the whole stock could re-rate higher over time. Watching that sales mix shift becomes maybe even more important than just the overall revenue number each quarter.
Absolutely. Now, of course, there are risks to this rosy scenario. We need to keep an eye on a few key things.
Okay, risk number one, cyclical risk. We saw C&I take a hit. But a really bad global recession could be worse, right?
It could cascade. If techs really pull back on buying even necessary tools, that strains the tools group and the financial services segment. You could see lower loan originations and maybe even higher credit losses. They've navigated cycles before, but a deep one would be a serious test.
Risk two, the big one, structural risk, the EV problem. The nightmare scenario is that the decline in the old ICE tool business happens faster than they can build up the new EV-related business.
Right. If that pivot to diagnostics, high-voltage tools, and training is too slow or not profitable enough, the core business faces a potentially irreversible decline. Execution on the pivot is everything here.
And finally, operational risk. The whole model leans heavily on those independent franchisees being healthy and motivated.
Exactly. If widespread economic pain hits those small business owners, causing financial distress across the network, that could seriously disrupt Snap-on's unique distribution advantage. Fixing that would be incredibly difficult and expensive. Hashtag tag conclusion and final provocative thought.
Okay, so let's wrap this up. What's the synthesis here? Snap-on is this fascinating mix, a super durable, high-quality, cash-generating present built on that unique moat, proven management, decades of margin expansion.
Right. The core is robust. That integrated system of brand, finance, distribution works. But they are undeniably at a critical juncture.
And the final verdict on long-term value really hangs on execution, doesn't it? The tools group will likely remain resilient near term, but the real key is the speed and success of that strategic shift into RS&I, diagnostics, information software to capture the EV future. They have to morph from just a tool company into more of a tech and safety provider.
Precisely. And that leads us to a final provocative thought for you, the listener, something that connects this tech pivot with the, frankly, huge responsibility that comes with it.
Okay. Given that this shift to EV repair demands not just new tools, but mandatory certified training for high voltage systems, systems where a mistake could be fatal, think about the enormous safety implications.
Right. As Snap-on pushes to be a key source for this certified training, partnering with groups like the IMI, selling this essential high-voltage safety gear, does their role fundamentally change? Are they moving beyond just selling tools to actually providing essential risk management for the entire auto service industry?
What are the long-term societal, maybe even legal consequences of becoming the de facto standard bearer for safety in this new EV world? Does this critical safety role make Snap-on not just a supplier, but an indispensable part of the infrastructure itself, something every shop must rely on to operate safely and legally?
Something to definitely think about as you watch this incredibly interesting company navigate its crucial pivot point.